Join me in welcoming Dennis and Joel.
Good morning. Good morning, Dennis.
Good morning. How do you hear me?
All right. We're past the technical difficulties. All right. Well, our presentation today, you see it up there, navigating long-term investments in the short-term trading world. I wish we could have done some slides for the Moody's downgrade of the U.S. debt today, but we didn't have a chance to do it. So we have a disclaimer we'd like to show real quickly. And then let's get to things here.
So just the background here, we'll just go back and introduce ourselves. Joel and myself have been professionally trading. Joel, you started in the pits in what, 86? 1986?
I don't want to go into all that stuff, but I started in the trading pits in Chicago in the mid-1980s. I was a market maker and a trader for oldie discount through the early or late 90s. Dennis and I met at Bright Trading 1999, and I ran that office, prop trading operation. That's where I met Dennis, did a lot of work with him. And I've been an independent trader and investor since then. And Dennis, I'll let it take away with your introduction.
Yeah, and I started with Joel. So I started trading retail in 1997 while I was in university. Then straight out of university, I joined Bright Trading in Detroit. Bright Trading was one of the biggest proprietary trading firms during that time in 1999. They had over 40 offices in the U.S., over 500 traders, just trading basically professionally, similar to what they did on the floor. Really, like Bright Trading got started from two floor traders, Bob Bright and Eddie Franco, 1994, and then kept expanding. So kind of bringing the floor to the desk. And, basically, we were in Bright Trading office in Detroit, and we were doing a lot of trading strategies that were traditionally done on the floor. So you can kind of think of Bright Trading as one of the first high-frequency trading firms, where they were coming in and obviously doing a lot of different strategies, which we're going to get into today. So I was with Bright Trading from 1999 till 2022. And then in the last 3 years, I've just been trading on my own. And Joel and I have recently started the Stock Trader Network, where we talk stocks. We have our morning podcast, Pre-Market Prep. And we have a live 24/7 chat room where we talk stocks all day, just bouncing trading ideas and, trying to give that, community for trading. So let's get started with what we're going to talk to you guys about today.
Before you go, I promised you I wouldn't tell any stories when you first started trading.
Oh, gosh.
Showing up at the office at 9:29 and 59 seconds. One other thing I'd like to add, for several years, we were affiliated with Benzinga, local media company covering the markets, and Pre-Market Prep was born there. And the Stock Trading Network is an offshoot of that. So Dennis, take it away with the presentation.
Yeah, so today we're going to talk to you about short-term trading in the context that even if you're, a long-term investor, even if you don't care about, what's happening in the short term, because you don't care about the next 5 minutes, you care about the next 5 years or 10 years, or maybe retirement 20 years down the road. It's important to understand the landscape. It's important to understand who is on the other side of your trades, because on the other side of your trades, typically in about 80 to 90% of the cases are likely high frequency traders. So what are they? What is this? Let's just jump into it. So what we're going to do today is we're going to talk about who's on the other side of the trades, and we're going to talk about their strategies and how they try to make money. And it's a lot of, things to think about, but, there's going to be some complicated stuff in this, but we're going to try to simplify as much as we can. So what we're going to do is talk about that short-term trading, and then talk about adjustments and execution tactics that the longer-term traders, and I mean by longer term, outside of milliseconds, need to adjust to not, to not get picked off basically by high-frequency traders. So not saying high-frequency trading is bad. I'm saying it's essential. It actually provides a lot of the liquidity needed to allow institutions to get in and out of orders, but there's also needs to be execution tactic adjustments so that you don't get taken advantage by some of the more predatory programs. And they're not all predatory, but we just we're going to outline a whole bunch of that today. We're going to talk about navigating the short-term noise, because we can see in this market environment you have whipsaws on every single headline. Algos are trading off of news. They're whipping the market up 100 S&P handles. They're whipping the market down 100 S&P handles just off of a Trump tweet. So we're going to talk about how to navigate that. And then we're going to go and close with like principles for long-term investing, which a lot of people out here are going to understand. We'll just give you our ideas as well. So very much so, we're going to be focused a lot on the short term here, just educating the audience here on what's happening in the short term.
Just to expand on that definition of short-term trading, not talking about scalping or actual day trading. A lot of institutions and hedge funds will do shorter-term trading, but to them, a short-term trade may be a week or 2 weeks, just trying to take advantage of inefficiencies in the markets. There's always violent rotations in the markets, growth, value. So when you look at short-term trading, what we're trying to convey to you is not the day trading, the scalping, but there's a lot of alpha in shorter-term trading that if you are not necessarily active in it, but you're following it, you won't be sideswiped by some of these violent moves in the markets. So
let's just define what is high frequency trading, because you hear this on CNBC and the media, and there's a lot of misconceptions of what it really is. So I'm going to really simplify it here. The bottom line, it's just the automation of many traditional trading strategies that were done on the trading floor. So those trading strategies come into two main categories. One is arbitrage, and the other is market making. That's the majority of high frequency trading. It's arbitrage and market making, which is really just leaning on orders. We're going to get into that. So first, let's talk about arbitrage. The first type of arbitrage, which we see in this market all the time, is information arbitrage. What we're talking about is breaking news. So Trump tweets out, "We've got a deal with China." The algos just start grabbing offers, and the S&P futures fly 50 points in 50 milliseconds. That's the information arbitrage. The high frequency traders moving in off the headline and grabbing every offer that's sitting out there. If your offer is sitting out there, you get picked off. So that's where we're going to be teaching you stuff like, if you're longer term, how not to get picked off by a more informed trader. And we're not talking about informed being, insider information. We're talking about that breaking news is acted on in milliseconds by the news algos. So if you're sitting out there with your order, you're more of a sitting duck. Intermarket arbitrage is simply just keeping prices in line between different markets. Stocks can be interlisted. You can think of, ETFs. There's a lot of, intermarket arbitrage going on where prices are just kept in line. So they're keeping prices in line. If the price of one stock security that's trading, overseas is, different than here, they will buy the one in the one market where it's lower, sell the other, and obviously considering currency effects as well. That's simply intermarket arbitrage. ETF and index arbitrage is something that controls the entire market. So we've always known index arbitrage. Think about like the S&P futures versus the SPY. That's simple index arbitrage. Also, obviously, the 500 stocks that make up the S&P 500 have to add up. The math has to add up at any given time from 9:30 to 4 o'clock. I say from 9:30 to 4 o'clock intentionally, and I'll get to that as well. ETF arbitrage is, simply the SPY with the 500 components, or you can get into all kinds of other stuff like the Qs. There's, 100 stocks in the Qs. You can go into the IWM and the 2,000 stocks in the IWM. There are programs out there that will buy the stocks and short the ETF if it gets out of a line, or vice versa, short the stocks and buy the ETF. I do some of that ETF arbitrage myself. Statistical arbitrage, which is something I specialize in as well, is more just looking at quantitative relationships. And it's not as simple as like 1 + 1 = 2. It's, so arbitrage, you think of arbitrage traditionally, it's just free money. Statistical arbitrage is a little bit different, where it's like there's a statistical relationship here, but it's not, like the 500 stocks have to add up all the time to the SPY. So it's a little bit more not as clear cut. So high frequency trader participates in this, but there's a lot of other quant firms that do this stuff too. So, and then we're talking like pairs trading. You could think of a simple pairs as like Coke versus Pepsi, Bank of America versus Citigroup. You could also think of sympathy trading. So if all of a sudden you have good news out of Apple, it drags up the rest of the Magnificent Seven, which we're talking about Amazon and Nvidia and Microsoft and Google, etc. So that's sympathy trading. These are the different types of arbitrage that short-term traders are doing.
What I'd like to add before we move on is that all this arbitrage that goes on, all the different algos and everything, it all comes down to math. Statistically, they're programming things. And there'll be a lot of wild fluctuations in the day and everything. But these algos and these arbs basically are flat at the end of the day. They're redefining their systems for the next day. So not that everyone can take advantage of these wild fluctuations, but that's just what it is. It's arbitrage. It keeps things in line. So the basis of our talk is trading, long-term in the short-term world. All these things happen, all these things going on. But at the end of the day, the math and hopefully the principles and the fundamentals of the market come to fruition at the end of the trading day.
So we're going to jump just a little more detail on a few of these. We won't jump into everything, but news algos. This is simply breaking news. The one thing that is breaking the most is obviously anything that comes from the Trump administration. You get, any thought or even a comment coming from Truth Social saying, yeah, we've had some good talks with China, or we've had some good talks with another country. That's going to make the markets go higher. We see comments coming obviously the other way where, well, even this morning where the China administration was coming out and talking about issues with chips and talking about the US administration and the US needing to back down on their restrictions, their chip restrictions, and we saw the market go down on that. So we are seeing these headlines happen not, every day, sometimes multiple times a day. Trump is completely controlling the algos and completely controlling the short-term narrative right now. Long-term, I always say, buy good companies at reasonable valuations. But in the short term, sometimes they'll give you opportunities to buy those companies at reasonable valuations. Sometimes these headlines can give you those opportunities. So just understand that the news algos are completely controlling the market, and the news algos are really feeding on Trump right now. And it got to a point where, a month ago, it almost seemed like nothing else mattered. It seemed like the individual company news didn't matter. All that mattered was what the next Trump headline was. Other, traditional news algo strategies, news coming from companies, earnings reports. We know Apple, reports earnings. Stock, is disappointing earnings, it's going to go down. If it's got good guidance, and it's going to go up. So earnings are a driver. The news algos are trading right at 4:30 Eastern when Apple breaks, that once a quarter, they're all over it. Guidance is always very important. If you're trading news, you have basically, you have the bottom line, the top line, and guidance to simplify it. The guidance always trumps the bottom line and the top line. So if you see a company come out and they miss, but they raise guidance, you can see the stock rally. So just, that's kind of the formula that the news algos use. Management changes, insider buys and sells. Insider sells don't seem to matter very often, simply because there's lots of reasons for insiders to sell. There's only one reason for insiders to buy, and that's because they believe the stock price is going higher. Recently, we saw UNH last week really get hit hard. Wall Street Journal with an article knocking it down further, saying, there's the potential that DOJ is investigating them. The stock really got hit hard. It's bouncing back today because there was insider buys on the weekend. There was multiple insider buys from the CFO, CEO, 4 other directors, and that kind of gives the company and the stock a vote of confidence. And that's what UNH was looking for. It needed a vote of confidence because it's, obviously been hit really hard on recent bad news. So seeing the CEO come in and buy stock in the open market, seeing the CFO come in and buy stock in the open market gives a vote of confidence. That's what news algos are doing. They're coming in and they'll be the first to react. They see the insider buys and they're buying the stock up. Economic data points always move the markets. Jobs are very important. CPI has been especially important lately in the last few years, simply because we've obviously been in an inflationary environment. As inflation has come lower, CPI hasn't been as important, but these economic data points, which typically break around 8:30, often move stocks significantly. Fed speak, we had a lot of that today. That's obviously algos are looking and keying in because lower interest rates are good for stocks. So if you get some hawkish comments coming from a Fed official, it's likely to knock prices down. The news algos will see that as negative and knock prices down. If you get dovish comments coming from a Fed official, news algos will read that and buy up the S&P. So obviously very important, and the news algos trade on all of this stuff. Now I'm going to talk about index arbitrage, and this is something, Joel.
I just want to make a couple comments.
Yep.
With Trump and the tariffs, deadlines, I'm not sure mean anything. What I think is important is to know whether it's a tariff stock or a non-tariff stock. There's certain stocks, certain sectors that are going to be affected a lot more. So the company could be doing everything right, but if they have more exposure to tariffs, then that's something that you want to figure in, to your long-term calculations. A lot of people thought Netflix, well, it's tariff-proof, right? Well, then Trump comes out and says, well, there's going to be a tariff on movies. So when you're grouping your stocks for your long-term investing, at least at this point, we don't really know when the tariffs are going to take place. We don't know what they're going to be. But certain stocks are going to react differently to the news that are in your portfolio. The news from companies, earnings still matter when it comes down to the bottom line. You have to be paying attention to the earnings. Some stocks report in the morning, pre-market, some report after hours. And even if you're not, trading or executing orders, following the price action in these issues could something, give you indications whether, other institutions are out there. The economic data points, they all come out at 8:30 a.m. Most of them come out at 8:30 a.m. And they all are a precursor to the Fed. And we know for long-term investing fundamentals, it comes down to interest rates. I don't happen to think they're going anywhere for a while, but there's a lot of different opinions. So the economic data points, looking at one individually, it's not that big of a deal, but looking at them at an aggregate and then see how the Fed reacts to it. There's also FOMC meetings once a month with Fed rate decisions. So, and your responsibility for the longer term investing, you can't pay attention to all the noise, but if you could filter down and look at some of these things, perhaps it can help you in your investment decisions.
Index arbitrage, something we just touched on, and just want to make this point. The S&P 500 obviously made up 500 different companies. 5 of them make up 26% of the index. Microsoft, 6.68%. NVIDIA, 6.6%. Apple, 6.35%. Google's in there if you combine them, actually. I didn't combine the Googles, and Joel would say that's 4.4, because if you take them separately, they're not top 5, but if you combine them, it is. And then Amazon and Meta. So you can see, this number here, when Joel and I were first covering the markets, we were sitting closer to 10 or 12%, the top 5 components. Now it's 26. So the market is very concentrated in just a few names. So these companies significantly, moves in these companies significantly impact the overall market. It is
We started the top stock in the S&P, and this is something that I like to follow by following the top components, was General Electric. Was a top component in the index. And then right next to it was ExxonMobil. So even though you're not doing the index arbitrage, to look at these components and look how the tech sector has evolved with many of the components, the other top ones in there, Tesla, Broadcom, gives you just a wider perspective. JP Morgan is like one of the only stalwarts that's really stuck around for a long time. But just wanted to add that on index arbitrage and just following the components of the index and knowing that the movement that these stocks, it's going to cause fluctuations in other stocks in the S&P 500 as well.
It's just amazing that, you talk about ExxonMobil and you talk about GE and you can talk about, and how it's evolved and how we become a technology economy. And now all the top components are tech stocks. So very, very concentrated in tech. So much so that in this next slide, and I've been teaching this for 5 years, so you see I've got a scenario from 2019 still applies here today. When you see, and you don't have to read all this stuff, I'm just going to sum it up for you. But when you see a major component beat, like a Facebook, that's a heavy weight in the Qs, it will actually put negative pressure on the non-tech components. And what does that mean? So the Qs, actually, if you look at the Qs, and I'm talking the 100 stocks that make up the NASDAQ 100, there is about 25 stocks in the Qs that are non-tech. Everybody thinks of the Qs as just being tech stocks, but there are 25 components of the Qs that are non-tech. So these are in the Qs: Costco, I would say it's not a tech stock; Starbucks, Kraft Heinz, Mondelez, CSX, Ross Stores, Monster Beverage, MAR. These are all in the Qs. Dollar Tree, Fastenal. That's the nuts and bolts of that. That's not a tech stock. Fox, Comcast, Gilead's a tech, biotech, but not really, a tech stock. These components, so these non-tech components, when you have a really heavy tech day, will actually go down. Like Comcast will go down on a day that Facebook or Meta is trading significantly higher on earnings. And that's simply because the math has to add up. So let's just say in this scenario where Meta beats, well, if Meta beats substantially and is trading up 9% after hours, that's making up almost 0.5% of move in the Qs. That means the other 99 components, have to add up to make up for that. So if Meta, for instance, and then that's going to make Amazon go higher and some of the other tech stocks in the Qs go higher, they've got to sell something to make the math add up. And that's why they go and pick on those non-tech components. So we call this, the media will say, oh, there's rotation. The rotation is actually caused by ETF effects. So if you're buying up all these tech stocks, you're going to sell the non-tech components. Pepsi will a lot of days go down on these days that these earnings, and this applies to earnings season mainly. So when you're seeing these days where, you've got a lot of tech stocks reporting earnings and tech is really strong, Pepsi will go down simply because it's part of the Qs and the math has to add up. So high frequency traders will sell those non-tech components and buy the tech components. So just know, grouping in, it's good to have these stocks. Is this a tech stock or a non-tech stock? And sometimes long-term underperformance can happen for the simple reason that tech has been too strong. So there's going to be underperformance in those non-tech components.
Just looking at the overall market when, it's a big up day in the market, and then you look at your Mondelez, your Kraft Heinz or something, and it's down on the day, that from the index arbitrage, I have absolutely nothing to do with the company. It just may be because of these ETF effects. So, if you're a momentum investor, trader, you're trying to identify, reasons why your stock, didn't participate with the overall market. Sometimes it just comes down to the simple math of tech stocks doing too much and putting pressures on the other issues in the index. And you can even just for a good exercise, pull up all the components of the triple Qs or the IWM and these different indexes, and you'll be surprised. Like Fastenal, you think about that being in the triple Qs.
Risk arbitrage, something that we've specialized at Bright Trading, and I specialized for a lot of years, is just the merger arbitrage. So we just had Discover and Capital One close today. So this was a merger that was on for a while. The ratio was 1.0192. So the takeover.
Hold on 1 second, Dennis.
Yep.
So just for trustees, going back to what you just finished talking about, one of the things on our quarterly reports, we always hear, well, we had underperformance in consumers and we had overperformance in financials or wherever that. So I just wanted to let you know, in case you didn't know, we hear that performance over and under on a quarterly basis. And that explanation was very helpful.
Okay, thank you.
The ETF effects, like I could do a 2-hour presentation on ETF effects, and we're trying to touch into a little bit of stuff, but it is so important in the market. Like it is just, and as we continue to create more ETFs, these effects are becoming more pronounced. It is controlling the market. So the short-term ETF arbitrage is dictating where these companies go. Like just imagine being, and we can just take, a non-tech component like Comcast. Just imagine being Comcast. And if I was to go to the Comcast board and say, your stock is going to go down tomorrow because Microsoft is doing too well, they would be like, what in the hell are you talking about? But this is the truth. This is what we have created by continually creating more and more ETFs. We have now got to where that is what drives price, and sometimes not company fundamentals anymore. And it gives us opportunities as long-term money managers. You do get opportunities to buy good companies at a reasonable valuation sometimes because of this. But it's so frustrating even, because I run my own long-term money. I've been trading for 27 years and I have a long-term portfolio. I'm cognizant of all of these effects, but and I'm heavily in tech, but it is disappointing sometimes to see your non-tech stocks just continue to underperform, to continue to trade at multiples when you have Tesla trading at a multiple 150 times earnings, and then you got General Motors trading 6 times earnings. And you're like, what gives? Does this make any sense? Logically, it doesn't, but when you take it from this ETF perspective, it does. So the problem is the boogeyman's out of the room, and these effects are not going to go away anytime soon. And we continue to create more ETFs, which only increase these effects. So I don't know, like the solution for this. And again, we can even dive in as we go further into the presentation. It's why the small caps are a mess. It's why everybody's so ultra focused on just a few companies. ETF effects are really driving price. Quickly, just running through some other stuff. Risk arbitrage. So these are deals. These are merger deals. This is just other stuff that high frequency trading is doing. So I won't stick on it too long, but you can clearly see, this was Bristol Myers Celgene from a few years ago. The charts are perfectly correlated. The algos actually serve a great purpose here in keeping these prices in line. Leaning on orders, market making.
With the risk arbitrage, Dennis, I want to hop in here 1 second.
Yeah, go.
Really not to emphasize like the ratios and the actual trading of it so much, but it's the trends. Things that are going on. If you're in a stock like who wants to take over Foot Locker, right? It was taking over a huge premium. Well, Dick's, whatever their master plan was, they did it. But you know what happened a few weeks before that? Skechers was bought out by private equity. So not focusing on the deals and the ratios and the trading of it, but it's just being cognizant of what, where the deals are and the sympathy plays with it. So, you've been holding Foot Locker, it's a dog, it's going down. It's not a reason to buy the stock, but when you look at it in the context of mergers, acquisitions, it did make sense.
Market making is the other aspect, the major aspect of high frequency trading. That's just being on the bid, being on the offer. Also off-exchange market making, where they're leaning on the bids and the offers. But the whole game in market making is just trying to capture the spread. They're in there for the spread. So there's rebate trading too, which we could go into as well. I'm going to fly through some of this stuff where you've got actually high-frequency traders and short-term traders just going in there trying to be on the bid and be on the offer and get the exchange rebates offered by the exchange. This stuff is very prevalent in smaller companies, that are thicker, but not so prevalent, in like a Google or something, which is a higher price stock. Advantages of high frequency traders. So what are their advantages? Speed, obviously speed. They're reacting. We know the co-location stuff that you've heard about in the media, it's reaction in milliseconds. They're trying to pick off the free money. But also high frequency traders have an advantage with payment for order flow arrangements, which is something that isn't talked a lot about in the media because it's misunderstood. But basically, there's high frequency trading firms that have relationships with retail brokers, where the retail brokers will route all of their orders to high frequency trading firms, and those high frequency trading firms basically have first dibs on trading against those orders. It's really captured order flow is what it is. So if they don't want to trade against those orders, then they may move them to the exchange for execution on the exchange. But those relationships are there. This is how you get the free trading. Like I always say, there's no such thing as free trading. So you think you're trading on a Robinhood for free, you are, but the cost is that your orders typically aren't going to the exchange, they're going to high frequency traders, and you're trying to obviously trade against those orders in the case where they deem your order to be uninformed. So there's no free lunch. What is the bottom line?
The leaning on orders and the market making. Now, trading, you guys are investing, you're probably putting in, some pretty large orders, and you're thinking, I'm trying to buy XYZ at $50, and your order's in there for days and days and days, and it doesn't get done. Well, that's because of the high frequency traders identifying an order like that, stepping out and buying it at 50.01. They could care less about the long-term direction of that stock. With their low transactions costs, if they could buy it at 01 or even fractions of a penny, 50.001, and sell it at 50.03, they will do that all day long. And then when you get filled on the order, it's going down, or at least in the interim. So I don't know how closely, how you guys and gals execute your orders, what you're looking at for the institutions, if you use VWAPs or price entry, but it's something to be aware of, is that these high frequency traders are out there on your big orders, putting things in, and they're leaning on it. So if you're looking at you're like, why didn't it get filled this day? Well, the HFTs are out. Boom. Then the next day, bad news on the stock. Your 50 big gets wiped out. They're taking the short side of that trade and buying it under $50. So that's kind of a simplified explanation of the leaning on orders.
And that can all sound scary, but the bottom line, for the most part, is the high frequency traders have monopolized the top of the order queue. What that means is they basically are always at the top of the queue. So that means that you as a non-high frequency trader is going to typically be at the back of the queue. So what do? You adjust your trading strategies. So what I want you to think about is the spread. The spread is the difference between the bid and the ask. That is really the HFT toll. That's the toll for liquidity. That's the toll they charge us. High frequency trading is not going away anytime soon. So you learn to live with it. So just think about the spread as being the high frequency trading toll. That's the cost to trade. If the spread's 2 cents, that's the cost to trade. What I will say is if you sit your limit orders out there, and what Joel was saying, it kind of makes you a sitting duck, because, if they're leaning on your order for protection, if the markets all of a sudden have bad news, they're hitting your bid and hitting your bid and hitting your bid. So the best thing you can do is just not have your orders sitting out there. And many institutional firms have adjusted from where they were trading 25 years ago, where all the orders were in the books. Now they're using, obviously, their algos of their own to try to slowly, if you got, buy 50,000 shares, slowly putting it out there, as opposed to sitting your order out there and then, having them lean on your order or getting picked off. So what I always say is sitting your limit orders out there kind of makes you a sitting duck. So how do we adjust? And this is, really as long-term traders, what do you do to adjust? First, I don't place, and even long-term traders isn't just like, so again, let's just stop and do the spectrum again. In this context, long-term trader is anything outside of high-frequency trading. So if you're even like a day trader or retail trader, this stuff applies to you as well. So it's not just like, to your institution or to your retirement fund, or it applies to all non-high frequency traders. So if your time horizon is longer than a few milliseconds, listen up, because this applies to you. So non-high frequency traders should use, instead of using passive limit orders, means sitting your orders out there and becoming that sitting duck, use more marketable limits. And what I mean by that is don't be afraid to pay the spread. Don't miss a trade for a penny. So if you're buying Bank of America and you're trying to sit on the bid here and you want to be, if you can lift 25,000 shares on the offer for a penny or two, do it. If your time horizon is longer, don't sit around and let them lean on your orders. Don't be afraid to pay the spread. If you don't want to pay the spread, there's other tactics too. Discretionary orders can slowly put your money in there, but midpoint orders are a huge tool. You can use midpoints where you actually find other institutions on the other side. Most of your exchanges allow midpoint. Most of your retail brokers allow midpoint orders as well now. So if the spread is 1 cent wide, where it's 25 to 25.01 in a really thick stock, you can try midpoint. Maybe you can get a 25.015 and save yourself half a cent. Midpoint orders are a great tool. I use them all day. Tip number 2, extend that time frame. Scalping, market making is reserved for high frequency traders only. If you think you're going to, be a scalper, you better be investing a lot in co-location, have millions of dollars, do all that to be able to compete with these firms. Think in terms of minutes or hours, not seconds and milliseconds. I've had to adjust my own personal trading because, like I said, at Bright Trading, we were kind of the original high frequency traders. We adjusted our time frame out a little bit back in 2010 because we just couldn't compete in the speed game anymore. So, we've moved to more statistical arbitrage, some other types of strategies there, but just move the time frame out a little bit. Don't try to go in there and I'm going to sit in here and make a penny, make a penny, make a penny. That's for the high frequency traders. Let them have their pennies. We'll make the dollars. Trade more liquid issues. So if you're obviously trading, and you're going to have to pay the spread, trade stocks in the S&P 500, trade stocks like Bank of America. You go into your small caps, and some of these stocks are 50 cents, $1 wide. I mean, how do you get in and out? And that's, on low volume too. So this is why I was saying I was going to say it. This is why the small cap space is a mess, because there's so much concentration in those mega cap names. All the liquidity is there. In the small caps, it's all off exchange market makers that dominate that space, and it's really hard to get done, and your slippage is huge. So I used to trade small caps all the time. Remember that, Joel? Back in the Bright office in 2000, 2001, 2002, I traded small caps all the time. I can't trade that stuff, not as a human being anymore. The spreads are too wide, and you put your bid out there, and then it penny jumps you. And you put your offer out there, and it penny jumps you. And then you see it trading at your price, and you don't get filled. Small caps are a mess, and that's why I just say avoid small caps. And I know it's hard for these smaller companies out there to obviously raise capital when there's so much concentration, but payment for order flow arrangements have really hurt the small cap space.
As far as adjusting your execution tactics, and we'll get a little bit into technical analysis a little bit later in the presentation, but really combining, the 3 things that Dennis mentioned: marketable limits, discretionary orders, not so much midpoint orders, but I'm not sure the size, of positions that you take or the time period that you use, but there's always a point. I don't know if you've talked to traders on desks, if your orders are big enough to do that, but think about it. If you want to buy a stock that's falling, and use UNH as an example, and there's bad news on it, you don't necessarily have to rush out there the first day. You got to at least wait. You don't know for sure if it's stopped going down, but expanding just your time frame, looking at the charts. We'll get in there. We'll get into that a little bit more in a second. Eric, you got something you want to add?
Yeah, just to fill you in a bit. Most of the trading is done. So our investment managers work with the custodians. So our involvement for trade, for the specifics, this granular stuff, we're a few steps back and behind from that. So as it relates to these specific details, it's helpful from an informational standpoint, but we're not making those decisions. We've got the professionals that are doing that and, working in appropriate, blocks and not, and work smoothing through things and not making those bids and trades just ourselves.
But it does apply in the fact that you can't, it does apply in the fact that understanding these mechanics keep you away from the small cap space, because slippage there can be 10, 20, 30%. I mean, that can add up over time. So even though if you have an execution broker that's doing the executing, there's still investment decisions being made on the long-term scale. And what we're trying to point out is, there's reasons to stay away from this space, and it's market structural reasons that are needed to stay away from like small cap space and staying where the liquidity is. So, that's just kind of my thoughts too. So I think even though obviously many of you may not be executing your own orders, understanding, why the markets, react the way they are, understanding the way the markets move, understanding the mechanics behind it will help you make those better decisions. And maybe you stay away from that, stock that's trading, with a small cap, because it's not going to have the liquidity to allow you to get in and out very easily.
I just wanted to make sure that you had that perspective, because some of that people may be thinking, why do I care? How does that relate? Because we've got the custodians and we've got the fund managers, and they've got their growth or value or large bid, small, international perspective. And that's why we've retained them with their expertise and their specific strategy. So I just want to make sure that to frame the narrative a little more. That's all.
Thank you. The other thing is not showing your hand. So just in the execution tactics of it, again, if your program's, getting its orders out there, there's a good chance, it gets sniffed out by shorter term traders, and that can obviously increase your slippage as well. But the main point I want to say is trying to ignore all the high frequency trading noise. And if you are a long-term investor, a lot of this, what I just said, is noise. A lot of it isn't important. The little minutiae, little, jumping around every day. So you've got to try to ignore maybe some of the media, maybe the headlines, maybe this chop environment, to just get the clearer picture of buying good companies at reasonable valuations, which brings us into our principles for long-term investing. Overall market trend. The markets tend to go higher in the long run. We talk about 10-year periods, and it's very hard to find a period. You could maybe find from 1968 to 80, a period where the Dow was down over those years. But for the most part, if you take any 10-year period, the markets usually go higher. So obviously investing. So, bottom line is I'm trying to show you the short-term stuff, and then trying to say you still need to focus on your long-term stuff. But the short-term will give you opportunities for the long-term as well. Think about flash crash day, May 6, 2010. Think about the ETF flash crash of 2016. Those were huge opportunities for long-term money managers, and they may have been scared, out of, seeing stuff like that happen. But, in the flash crash of May, I'm talking about the flash crash of May 6, 2010, where the S&P futures quickly fell, 8%, and you had certain stocks that traded down to 1 cent a share, 336 stocks traded 1 cent a share during that. Market mechanics were kind of behind that. It was homogenous liquidity, where you had too many liquidity providers that were trading short term. And again, that's the problem with our liquidity today. It's all the same few firms providing the majority of the market's liquidity. But if you just think with the long term, still those principles for long-term investing do apply. Obviously, think about the macro environment, what we're into, valuation we can get into. I always say focus more on forward PE than past PE. NVIDIA would be a great example. If you were looking at always, just the PE ratio of NVIDIA, and last year in the early 2024, it was trading 110 times earnings. You're like, well, this doesn't make any sense at all. But if you were looking at the projections and looking out forward, the forward PE was only 25 at that time. We know NVIDIA went from $20 a share up to $120 a share over that course of time, and the forward PE is still the same today. So you've got to always kind of be looking more to the forward PE as opposed to looking backwards. What I just said, buying good companies at reasonable valuations, always important. And then story. Story is everything. In the short term, valuation is meaningless. In the long term, it matters. It is everything. But story drives price. ETFs are driven by story. New ETFs launch because they got a sexy story. It's hard launching an ETF, on some value ETF, because it's just not sexy. So investors aren't gravitated to that. But in the long run, valuation does matter. And then using technical analysis to time your entries and exits. And I think this applies to long-term investing and investors as well, because, you see good opportunities. UNH going from $600 a month ago to $250 last week. It's up over $300 this morning. If you're using some technicals, and we'll teach you just quickly in the next 4 minutes about some technical analysis, it may help you better to like get in, at better prices, because technicals apply on all time frames.
Kind of bringing this all together, and Eric, your comments were very helpful. Choosing your investment managers, and maybe taking a look at the presentation today. You guys talk to different groups. They're vying for your business. If anything that we hope that you can take away from this presentation is that when you're talking to the people, these managers, they want your business. Maybe you have a list of questions, a list of things to go in. I mean, they want your business, and they're gonna make a pitch to do it. But we hope the presentation, we'll go over the technical analysis here in a second, but they don't know everything. And the more skilled you're representing people's retirement funds, the more basic understanding that you have of the overall markets, and the better questions that you can ask them may help you choose, your managers in a little bit different way. I'm going to do this technical analysis just real quick. 5 seconds. You could probably use this, for your personal investing too, or, relating to the funds. But it just comes down to support. That's when a stock is going down, where it might potentially stop. Resistance, when a stock is going higher, where there's possible sellers or groups of sellers. Always trends, looking at trends, daily trends, weekly trends, monthly trends. If you're looking at performance from your perspective, I think it's most important to pay attention to the monthly charts. And then this is probably getting real technical, but every move has a counter move in the markets. So if you're looking at something and you wanted to buy XYZ, it went to 50, it went to 100, I totally missed it. Well, a 50% retracement coming back to the $75 area could be an area where, okay, we missed it. Well, it came back to this area, buyers are reemerging. So Dennis, you ripped through the slides on that. Wanted to share that. Technical analysis, I don't know if when you're talking to your managers, like how much they use it, how much they incorporate it, but just be aware that a lot of the trading that goes on in the markets has absolutely nothing to do with the fundamentals of the company. It has much more to do with technical analysis and how people are viewing things. So just something, keep in the back of your mind, not to get real complicated on it, but we want to share those basic tenets with you.
So just in summary, we're just ending our presentation here. High frequency trading have monopolized the top of the queue. Need to adjust your execution tactics for this HFT environment. Biggest thing is extend your time frame. Trade liquid stocks, invest in liquid stocks. Because if you're investing in illiquid stocks, your slippage is going to be huge and it's really going to impact your performance. So you need to invest in liquid stocks as well. Try to ignore this short-term high-frequency trading noise. I know a lot of stuff I showed may be confusing, but these are the mechanics that are running the market and running prices. Good companies at reasonable valuations still applies, and then technicals, using technicals to time your entries and exits.
You mentioned that small caps aren't a real good opportunity right now because of the high-frequency traders. What has to happen for small caps to be a good investment again? Because if you think about it, all big cap companies, large cap companies started out as a small cap company at one time. What has to happen to make those good opportunities again?
It's a difficult road. It does happen though. One is, if you're looking at new startups, and this is the main reason we don't even see that many IPOs anymore. Like you can even take it from, further, like looking, at new issues coming in the market. And it's been a tough sled for a lot of these companies. Really what, drives is like a sexy story, and then that can drive retail, and then that can drive in high frequency trading and algos, liquidity follows retail. So you do see some smaller names that actually can get a following, but it's hard to get over that hump. So small caps always have, a tougher battle. A sexy story can get them over that hump faster, but again, it's tough because liquidity begets more liquidity. And if there's no liquidity in a name, so many other fund managers, but also high frequency traders just avoid that stuff. And it's almost like trade by appointment only. It's hard to get in and out of those stocks. So it's a really difficult road, but really the driver of, that can be is a sexy story. They got a cool story. Oh, that's a cool idea. That can, help, but it's tough. Small caps are a mess. They've been a mess for years. The SEC has been looking at it too. Payment for order flow arrangements have hurt that as well. It's just, there's just no liquidity in these names, and a lot of fund managers avoid them just because the slippage is just too high.
I think a big overhang on the small cap stocks as of late is interest rates. A lot of these companies are not profitable. Biotech companies, for example. They need to borrow money. And in this interest rate environment, it's not as easy as it was before. So I think that one thing, who knows what the Fed's going to do? Who knows where his inflation is going? But I think until you get lower rates, I don't know if it's a quarter point, a half a point, or whatever, these companies need money. And aside from the technical things that Dennis is talking about, interest rates, tech stocks, they just make money, right? Apple, how much cash? It's earning 5-6% on its cash that it has in the till. NVIDIA, they're cash cows. They can expand, they can build new factories. But these smaller caps, a lot of it, you look at their debt, I mean, they're buried in it. So besides, like I said, besides the technical things Dennis mentioned,
lower interest rates would help.
Yeah,
lower interest rates would help.
Definitely help. Do you hear that, Dennis?
No, can you just repeat the question, Joel? Sorry.
It's where do we draw the line for liquidity for small caps? And
That's a fantastic question. It's a question I get all the time. So I think it's all about volume. So, we can look at market cap and say, oh, I'm not going to trade anything that's under a certain market cap. But from a trading perspective and even an investing perspective and a slippage perspective, it's not so much about market cap. It's more about volume. So you can have some some large cap companies that don't trade that much, and they're actually harder to get in and out of. So it's more about volume. And you have some small cap companies that can trade fairly actively. But for the most part, I would focus more on volume. My rule of thumb for traders, and again, obviously long-term investing is a little bit different, but again, as a long-term investor, you've got to always remember you are a trader when you are, coming up with that idea and executing. So, and as a long-term investor, I can't imagine trying to get out of some of these names if they trade 50,000 shares a day and you're trying to buy like 1 million shares of it. You got 20 days of volume there, and on one side, I mean, how do you do that? So I've always just been of the opinion that if it's trading under 1 million shares a day, I tend to avoid it. Now, again, there's opportunities in some of the small cap space, but there's a fundamental market structural reason why small caps have outperformed for so long. And I mean, if we look at slides and we look at, the performance, you know what I'm talking about. You look at the IWM and you're like, well, small caps have got to catch up. Small caps eventually are going to catch up to this market. And we've been waiting for this small cap rally for a long time. They have been underperforming the market for over 10 years. And does that continue? If interest rates start to go down, it will help. But again, think about who else is interested in these names. So you can have a really cool idea, a really cool company, but if it's not, retail, and retail is a big part of this market too. If it's not like a cool idea, it's hard for those stocks to really get interest and then allow, institutions to get in and out of them. So I tend to avoid stocks that trade under 1 million shares a day. Now, again, maybe there's a place for fight. We could probably lower that to 500,000. But if you're trying to trade something that trades 10, 15, 20,000 shares a day, the slippage is going to be enormous.
Now, I think just to relate this to what your primary role is in choosing managers and having them make the investment decisions, it could just be, the cost of doing business in some of these stocks. They have been, they may have had the right idea over a period of time, But if you're, if they're trying to move X amount of shares, and if they're doing it for you, they're probably doing it for someone else through their fund. So just a lot of time. Once again, when you're talking to, different managers, you're looking at, different sectors to invest in, maybe that's some valid questions you can ask them. Question for Dennis here. You mentioned earlier that you have a long-term portfolio and short-term, and I'm kind of curious to know what the split is on that. Are you 75% as in long-term versus your short-term? And then follow up, did you do any trades during your presentation here?
That's a great question. I get this question all the time too. Actually, the majority of my money is probably in the short term. About 75% is in my short-term trading account where I'm moving that money actively, and probably it's probably more because I have other things, right? So if you're just thinking cash, but I've got real estate, I've got some different stuff. It's probably half in short-term trading and half in like longer-term investing type stuff. Some of that's real estate, but also I try to just obviously I've got my CFA designation. I've been actively involved with the Capital Markets Policy Council at the CFA Institute for 6 years. I wrote for CFA Magazine. So I've got definitely a lot of interest in the long term as well. It's why it's always like a balancing act. When you're a short-term trader, but you're trying to balance your long-term investing. And what you have to do absolutely when you have, when you're a short-term trader, you got to keep it separate. Keep your short-term trading in one account and keep your long-term investing in another account. And in the long-term investing, I get opportunities, and my short-term helps me with that because, you see the market selling off, you think, okay, well, finally, this is at a good company at a reasonable valuation. I'm going to maybe trade some of this, but I'm maybe going to stick some in my long-term retirement account as well. The stocks I have in my long-term retirement are mostly tech stocks. And why? Because that's been what works. And that's, those stocks have grown as well. I have a lot of the big ones like NVIDIA, AMD. I have, a core position in the Qs. I have a core position in the S&P. So a little bit of index stuff in there too. But, it's fun to pick stocks as well. So you get some speculative plays in there as well too. But if you look at the majority of the stocks that I trade are higher volume stocks, and most of the stocks I invest in are similar. So slippage is an issue, even on, from a smaller perspective. So I try to trade and invest in more liquid stuff and sexy stories because story really drives price. And the second part of the question, what was the second part?
Did you trade anything while you're talking?
Oh, did I trade any? No, I didn't. I actually was not trading here. On the pre-market prep show, though, when I do that regular podcast, sometimes I've got I'm working trades as well, and then we're talking. And in Stock Trader Network, we're trading as a group together sometimes. Like we've got obviously, a good group of people in there, and we're coming up with ideas and trying to figure out, as a community what to trade.
He doesn't stop talking, so he has to be trading. But if there's no more questions, I just really like to thank Eric Gould and MAPERS for having us out here. I know we got pretty technical into things, but we have a different perspective on the markets, and we wanted to share that with you. You have a very important responsibility with people's retirement funds, and we hope we can assist you in managing, and if anything, give you a different perspective on the markets. When you hear HFT, you can say, you can cringe at them. But we wish you all the best of luck. Thanks again to Eric, also Michelle, Maples, Mario, and the tech crew. Unbelievable here. I get nervous about this kind of tech stuff. So thank you for having us, and I'm going to be around for a little bit if you have any individual questions.
Thanks, everyone.
Thank you, both Joel and Dennis, for a great presentation.